Hello, traders. This is your trader's friend. Thank you for joining me today for another video. I'm sorry about my voice, but this is some information that I wanted to give out to you. And I'm going to tell you, and please keep this in mind, that your chart is your best teacher. Today I want to talk to you about breaks at the 50 SMA. Both good breaks and bad breaks, and I want to show you what a good break looks like versus a bad break. Now we're going to take today's price action. Here we have at 9:52 we have a break of that 50 SMA. Now notice what happens. Pretty soon thereafter you have a break back above. That's a bad trade. And I want to add this up front. I know I've heard other traders talk about stop losses being too tight. I have a preference for a tight stop loss because if I'm wrong, I want to know immediately. I don't want the market eating into my pocket all day long before I figure out that I'm wrong. So I want to know immediately. And let me tell you, if you enter a good trade, and this is how I determine my stop losses. Okay, here's my break. Okay, that's my entry candle. My stop loss is going to be a few pips below the candle before my entry candle. So notice if you get into a good trade on the break of the 50 SMA, this candle is never really challenged. And you'll see we got a beautiful bleed up. Now once I come back and break my 50, then I know at that point to go ahead and exit the market. So this is where I exit. This is my entry. And we are talking approximately, and I should have done this before I got into it. Okay, so that's about 51 pips right there. So this was actually today's price action. This is the time to get out. Notice again, when you get the break of that 50, you come back and you get a retrace. However, you do not challenge this candle here, and price continues to go up in your favor. This is your exit point again. So this was actually today's price action. Let's go back in the chart because I know I'm showing you past price action, but it's the principle that I want you to get. And instead of waiting for the break of the 200 SMA like I've been doing, I'm going to go back to the break of the 50 because I realize that if I get into a good 50 break, then I'm going to have sweeter profits, just a little bit more. Let's take a look at some more charts. Okay, this is November 9th. And I apologize to you because I'm sucking on a cough drop there. But let's take a look at these charts. Now, notice here, this is November 8th. You have a break of that 50. And notice how the candle above is never challenged. If you're in a situation where that candle is challenged a few pips above, go ahead and get out because your trade is not giving you the best possible advantage. Okay, and let me show you a bad trade up close. You see how you got that break of the 50? You enter, pretty soon you're stopped out again. You get a break, you're stopped out again. Those, that's how you know that you've entered a trade that's not giving you the best advantage. Here, you have a break, you got a pretty good bleed down. That's what you're looking for. If price comes back to challenge that candle, which would be here, a few pips above, if it comes back a few pips above, that trade is not going to give you the biggest advantage. Now look here. Here's that break of the 50. This would be the previous candle. Your stop loss would go just below, a few pips below that candle. If that stop loss is violated, go ahead and get out because you'll see that if you have a good trade, it's going to bleed up in your favor beautifully. And here we're talking about a 70 pip run. Once you get a break below that 50 SMA, go ahead and get out. And I think that's all I wanted to show you on that chart. But it's the principle, and you can go back as far as you can in your chart and you'll see these things again. I've already showed you that. And this is actually where your stop loss would go. So this is that same kind of thing. Now here you have the break below that 50 SMA, and you can see again that you come back and you're stopped out. And I'll tell you, I do not use physical stop losses, and the truth is I'm a chicken. That's why I don't do it. However, um, I do once that stop loss is violated, and a lot of times when I'm in multiple trades, I'll go ahead and write down where my stop loss is on a sheet of paper. Once that stop loss is violated, then I'm not at the best possible advantage, and I know it's time to cut that trade. Let's take a look at the same principle on the 1 hour time frame. Here you have November 22nd. You have that break below that 50. This would be your entry candle. Notice that even though price retraces, you never challenge that stop loss, and it continues to bleed down beautifully until this point. That is just a little over 300 pips, guys, in that trade. That's enough. If you decide to go long on this, all you get out of all of these hours is 10 pips max. That's it. Before price comes back to challenge that area, and then eventually you're stopped out. That's not a good trade. That's how you know if you're using your 50 SMA whether or not you have entered a good trade or a bad trade. Guys, you can absolutely do this. And the key to trading is protecting as much of your capital as you can, because during the course of the day what you get is a lot of choppy price action, and that's why it is so good to know the best times to trade. And let me tell you, I get tricked. I get tricked. And I want to add this too: the closer your 200 SMA to your 50, the sweeter it seems that your ride is. But I've been tricked like that before, and tricked badly. This is the thing. After a while, you'll learn to spot good trades, but your advantage comes in learning to close bad trades quickly. And never let them trap you. Guys, you can absolutely do this. You can be successful at Forex. Have a terrific trading week.